Hi, everybody. This is David Skrika. So just going to do a video here. So what I'm going to do is I've just been brainstorming. One reason I've taken longer than expected to start this, my pay service up. I was just thinking certain things I want to do. There's things I want to do more than just the pay newsletter again. You know, a lot of things have changed, obviously, I guess it's almost 25 years since I've been in this business. I started in 1998. Well, at all the age of 21. Which is making me feel pretty old, actually. But anyhow, you know, definitely a few wrinkles, a little more gray, a few gray hairs, a little fatter than when I started all those years ago. But anyhow, what I want to do here is I'm going to do different tiers. Now, right now, I consult with companies, and that was really to raise money. That's the main thing. But that's all this sort of thing going on. But everything can be cyclical, right? Like when markets are bad right now in the juniors, or just as a whole, and I've been bearish and I've been making money shorting, but the problem is it makes it very difficult to make money on those other streams of my business. And you can't just live off trading, because there are going to be times in both bull and bear markets where you're not going to make anything. So then, obviously I stopped the pay newsletter, but things have changed, in those 25 years from everything, really internet newsletters were just starting when I started out. And then of course they became mainstream where everything was in PDFs, password protected, pay for subscriptions. And then, and now everything seems to be moving more to media, more podcasts, more streams, more, video vlogs, whatever you want to call them, and that sort of thing. So I'm going to move to like the newsletter being more of like a trading service. I don't think I'm ever going to get back to a monthly, I'll write articles from time to time, but I don't think I'll ever get back to a monthly newsletter. I think I'll do more of the video media stuff. It's easier to do. I feel that you get your point across stronger with the visuals, and you can tell more information in a shorter period of time. So it really, really works. So, but what I'm going to do is, my newsletter, which will have more of the stock picks or more of the stock watch list, the option trading you've seen, that will all be restricted to the pay letter. That's going to be about $70 a month. I got a lifetime subscription for $2,500 a month. And what I'll do is I'll start offering that when I open up the newsletter. It's going to be June the 1st, and for the 1 month period, June to 1st to June the 30th, I will offer that. For about for half the price, for $1,250 US, or roughly, or for Canadian, 1,600 Canadian. So that's what I'll do, and that will also include, I'm going to have a list where I'll give real-time alerts via text message. And then also you can actually ask me questions versus text messages. Obviously, I would ask people, be respectful of my number and be respectful of my time, and not been bombarding me with messages. Maybe I'd restrict a subscriber to one question a week or something, but something along those lines, and maybe even do a video presentation to the lifetime members as well in that top end. So basically that, but also I like these educational videos I do. I think they help people out a lot. So I'm probably going to do them, maybe an interview with someone once a week. So I'm going to do two sorts of things, maybe show big macro long-term trends like I'm about to show in this video. This video is going to be about maximum pessimism investing in depressed assets, which I believe is the #1 way to invest. One issue with having a newsletter, you feel like you always have to give recommendations. You always have to be trading. If it was up to me personally, this would be the only way I'll invest. But the problem is you would have maybe 3 months, 6 months, even a year or 2 year periods where you would do nothing. And then really pile in when you saw a good opportunity. But I think this is the best way to invest. And I think in the long run, it gives you the best returns, which I'll show you about. And then I'm also going to do a new segment on historic investors. So I'm someone who loves to learn from the best of the best, from, regardless of what you think of his politics, from George Soros, from Paul Tudor Jones, John Templeton, Warren Buffett, people of this nature. So I think I'm going to show like trading strategies, way to trade, and these kind of historic legends. Now, I think I'll do one video of that a week. And obviously there's only so much I can do with that. So that might be a service that or a series that only lasts a few years, but I think it's a great way to maybe introduce people to these legends and, you know, I'll do it once every week to 2 weeks, you know, depending on how much research I have to do, learning about a legend. You know, and I think I'll do that. And so what I would like for you to do and ask, even my current lifetime members to do this, and even my soon to be hopefully monthly subscribers, that I'm probably going to set up a Patreon account. And then if we can just, I'll probably do it at, you know, $5.99 US a month. So about $6 US, 8 Canadian a month. If you just sign up for that, you know, it's $6 is 20 cents a day. You know, it's not too much to ask, I don't think. And for the 2 to 3 videos I do a week on this kind of more macro type thing, and you know, it will help me because I'm someone who, you know, I was about to use that for, but who absolutely hates to market. I don't like marketing. I don't like doing the landing pages. I don't like pushing stuff on people. Like, if you like what I write and if it makes you think it can make you money, sign up for my newsletter. That's the way I am. But you do have to market in this business. But the nice thing about doing this is, if I can get whatever 500, 1,000, 2,000 people signed up to service like this, which I think will be helpful, I don't really have to market. That will basically be my living costs, and it will allow me to concentrate on finding the best deals to invest in, do private placements in, and also finding, you know, the best stocks to buy when there's opportunities arise, instead of having to waste time marketing. So that's all I'm going to ask you. I don't think it's too much to ask. You know, for those of you, you know, getting these things, and it will be voluntarily because it's a Patreon service. Obviously, for people on the Patreon service, like maybe on my free service, I will only do, you know, maybe one video a week or 2 videos a week, and we'll probably do like, you know, 3 or something for the people on the Patreon service. So I have to give you a little bit extra for paying. But that would be great if you would sign up for that, and I would really, really love that. And like I said, it would basically make me, so I could just focus on research and doing what I love to do. And I'm also going to have these kind of travel lifestyle things. So the whole thing is going to expand, and I think it's going to be really entertaining. And I'm trying to make it fun. Like, for a while I wanted to run a hedge fund, but you have to be who you are. I think I'm pretty kind of entertaining. I don't take myself too seriously. I'm very politically incorrect. You're going to see, I'm going to have some very attractive girls in some of these services that I do, you know, helping me out with the interviews and getting, you know, relaying them, kind of teaching them about investing and that sort of thing. So it's going to be fun, and it's not going to take itself too seriously. And I think people have to take themselves less seriously. You know how many times when I've been bearish the market, you know, I have had, you know, people like, I had one guy write me a real nasty letter when I was shorting a few weeks ago. I was like, dude, calm down. You don't like it, I'm bearish. Don't read what I have to say. You don't have to, like, you know, he was writing stuff about me, you know, getting it up the, you know what, you know, from behind. I'm like, what? Yeah, chill out, man. You know, anyhow, so we're going to show you maximum pessimism investing. So this is a great way to invest, and I think the best way to invest. So this is a great article. If anyone, I'll send a link to this article underneath this video, and it's basically what happens when you buy assets down 80% from the highs. And it's by Maybain Faber. This was kind of John Templeton's article. Well, I'll talk more about Templeton in the video thing I do, vlog I do about him. But basically, one of Templeton's famous trades was in the late 30s. He thought because of the restarting of the war, railroad stocks would do really well. And his idea was, all of a sudden the U.S. would be making ammunition, making, you know, tanks, planes, etc. And then it would mean that, you know, the railroads, you know, it's a lot of industrial capacity at that time was in the Midwest, you know, places like Chicago, places that like, you know, Missouri, you know, Kansas, etc. And they would be made in these places and then be shipped out to ports and then shipped to, you know, whatever, either to fight in the Pacific, fight in Europe, etc. So he was like, the railroads, which had been completely depressed because of the Great Depression, he bought 100 of them under $1 a share. He actually borrowed $10,000 from a friend to do it because Templeton was not yet that wealthy, right? And, you know, 10,000 at that time is probably like, this is 1930s, you're probably talking $500,000 today, right? Or maybe, you know, I would say between $250,000 and $500,000. You know, I think inflation's probably gone up 25 to 50 times, depending on the measure you look at since then. So anyhow, this did great. He turned that 100,000 in, or so 10,000 into 100,000. Many of the investments went up 50 or 100 to 1. etc. And many of the railroads were actually in bankruptcy, came out of bankruptcy, and thrived during the war. So this study by Maybe and Favor does a similar thing where Templeton was buying these depressed railroads. What happens when you buy depressed assets? So if you buy a sector that's down, 60, 70, 80, or 90% since the 20s, you can see your average 3-year return is anywhere from 57 to 240%. So basically you're going up, and that's very difficult to get returns like that. Do you really think on the S&P at 4,000 you're going to get it to 6,000 within 3 years? Probably not at the valuations that you're at right now. But for example, if you had bought in the S&P 666 in 2009 when it was down about 60% from its all-time high, and many stocks in it were down 70, 80, 90%, the S&P went up, phenomenally, 6-7-fold over the next, 12, 13 years. So anyhow, it just shows you. So a 3-year return when you're buying an industry, again, 71, 96, 136, 115. So again, anywhere from 71 to 136% when you're buying the industry in a 3-year return. And then when you're buying a country down, so you just say like, we're going to talk about Sri Lanka. Sri Lanka would be a country right now, down 60, 70, 80, or 90%. Again, returns from anywhere from just over 100% to 156%. So there are certain things that you worry about. There's certain things that takes time. I'm going to show you charts of that. Sometimes stocks, when they're down like that, don't just have V bottoms. Sometimes they do. Sometimes you have to wait for years for that to plan out. But you almost always make money over a 3 to 5 year period and outperform the market when that is the case. So we're going to look at that. So I'm going to start up with, I'm going to give you examples of some of these things. So a long-term example I'm going to give you of a company that trades in such a manner as Ford. Now we all know that car companies are super cyclical, right? And because recessions, the margins are thin, they have a lot of debt. Recessions squeeze the small margins that they have. They obviously have a huge overhead with, plants, huge amounts of employers, etc. So you can see this car company, Ford, in every recession of the past 35 years, so going back to the early 90s recession, Ford has gone to under $4 a share. It went to about 3 in between 90 and 92 or late 91. It went to right to 4 in 01-02. It went to $1 in 2008, and it touched 4 again in 2020. So again, the 4 recessions that we had, if you had bought in Ford at $4, which in each case would have been anywhere from 60 to 80, 90% from its lows, or from its high, sorry, you would have these great returns. Like in the early 90s, Ford went from 3 to over $20 a share. In 2002 or 2001, it had a quick move to over $10 a share from 4. And then in 08, it went from 1 to 12. And then again, in 2020, it went from $4 to over 20, 5 times your money. So virtually the worst return was being 2.5 times your money, and the best return was over 10 times your money. And of course, if you didn't sell here waiting for a higher price, even if you had held through this 10-year period, your 4 would have become 12, which was a triple, and then or if you would have held 20 years, you would have made over 5 times your money, which still over a 20-year period is still pretty good, And of course, Ford, especially during the boom times, pays pretty good dividends. So that's an example of a stock that, really, I've been shorting Ford on and off. I covered my put position, I sold it, but I think that ultimately you want to buy Ford at $4 a share, and you don't have to put your whole position in. It's just in the case that you do have an more extreme decline, like yet in 08, 09, you can kind of average down. So, but I think that Ford will be heading back to $3 to $4 a share in the upcoming recession. So let me give you an example of a stock I looked at. This is talking about a country, but I did not buy. Now, if you remember in the 2008 financial crisis, Iceland was one of the worst performing countries. They got overly leveraged. They were attracting investors from the UK by having these they were attracting investors from the UK by having huge interest payments at a time when rates were low in the 2000s out of their banks. And they had a big housing boom. They kind of liberalized the economy, and then it kind of got overstretched and it completely collapsed. So this is Icelandic Air Group, which went from 30 Icelandic kronas to under $2, under 2 kronas, and then which is down, it's down 90, 3%. And then you can see over the next 15 years, or sorry, the next 7 years, went to 38, a share. So it went over up 20 times. And you see the Icelandic Air Group has collapsed. Now, WOW, which was a competitor, which was this discount airline, collapsed, went bankrupt. So, well, Icelandic Air do the same as them. But the good thing about WOW going bankrupt is Icelandic Air basically has no competition. Now, of course, Iceland is very, very, isolated, and high oil costs really hurt them because it makes, it takes forever anywhere to get to Iceland. UK is probably the closest spot, and that takes at least 3 hours as well. So it's not a short flight. It's not like in the US, you can fly from, Philadelphia to Boston and be there in half an hour or something, right? Or even in the Bahamas, we can be in Miami in a half an hour, right? You're not going to get that kind of thing. So higher costs will make make it so there's no cheap flights to Iceland. But I think now you're probably worth at some point in here, taking a bet. Now you would need a way to trade the Icelandic stock market, but we're talking like the krona is about 130 to the dollar. So you're talking, this is basically a penny a share. So and you can see it kind of hit it. It really been collapsing. I really got hit hard by COVID and lack of travel. Iceland is actually a tourist destination because of, all of the volcano, all the hot springs and all of this sort of thing as well, And anyhow, so you can see it really got hit, hasn't really recovered from COVID, but it might be worth a shot here. And what, with it being roughly a penny a share, buy 100,000 shares. It'll cost you $1,300, right? And just wait. So I think in Interactive Brokers, you should be able to trade this. But this would be a great maximum pessimism play, and could potentially go up 5-10 fold in the coming years. So then another play right now, and I'm going to show you, these are current plays and show you how they work. I'm going to show you past plays, but another current play I'm looking at right now is Sri Lanka now is collapsing right now. So this is John Keel's holding. So this is a company that in Sri Lanka basically it has a big holding company, owns all kinds of businesses and everything from real estate to industrials, everything in Sri Lanka, right? Owns dozens and dozens of businesses. And you can see that this too has collapsed from, about, this is actually the US dollar price, just so you know, because you see this is a USD. So it's collapsed from, 7-8 USD in the late 90s, back to the 2008 and 2001, 2002 lows, roughly 60, 70 cents a share. The Icelandic market is down about 50%, but in US dollar terms, the Icelandic market, and this is just the last year, not from its all-time highs, is down 75 to 80% because the currency is also down 40%. So I think we're getting to the point where Iceland is going to get some kind, or sorry, Sri Lanka. This is the Sri Lankan market. I mean, Sri Lanka is going to get some kind of bailout. You see, the Sri Lanka had a nice bottom, and Sri Lanka bottomed right when the war ended, and this had a very nice move, went up to about 5-6 times in value because the end of the war kind of brought this like post-war boom to Sri Lanka for a few years. So this is a diversified company. It trades on the Luxembourg exchange under the ticker John K. You could also trade it on the Colombo exchange in Sri Lanka. And I think this is to be an excellent way to play a kind of rebound because they are going to get a bailout. The world is not going to let Sri Lanka completely collapse and go to the abyss. So I bet you some IMF money will come in, help them with the importation of gas, etc. Something is going to happen here. And this is, again, a perfect example of a maximum pessimism trade. Now, if we can even go lower, you can see actually went to 50 cents in 2001. And right now we're close to there, but we're not quite yet. We're at 69 cents. If we can go lower on this to say 40, 50 cents, you can see the all-time low is 40 cents. I would even want to do this even more. And this is the kind of thing I think you buy and you look at it in, 2 years. You don't even try to trade it. So that's the kind of thing we're talking about. So I've done this in the past. For those of you who are long-term subscribers to the newsletter, will remember I was recommending hltoy. So the background on this was, this is the Greek telecom company. This is a large company in Greece, obviously. And you can see that it fell from the financial crisis high of $15 a share to under $1 a share. I think about $1.40 is when I started to look at it. And we kind of averaged, and I think our average price ended up being about $1. And you can see it quickly went to 2013, 14, went to $7 a share. And now it's at $9 a share. I do not own anymore. But also they pay about a 50, 60% or 60 cents a share dividend. So if you had bought at $1 a share, let's say for argument, you bought $10,000 worth, 10,000 shares, that would be worth, nearly $90,000 now. Plus you'd be getting about 5,000 to 6,000 a share in dividends. You'd be getting your money back every 2 years just in dividends, right? So there's another example. Another example of a stock that had maximum pessimism trade was TIO. This is I never did this trade. I was young at the time, but this was Telecom Argentina. You remember Argentina 01, 02 had a huge financial crisis. You can see the stock went to 50 cents a share. I think it went to 25, actually, was a bottom, completely collapsed. Argentina recovered, had a recovery into 2007. This went from 25, 50 cents a share to $15 a share. We're talking 30 to 60 times on your money, you can see how well this did. And then you can see, even here, and even in the financial crisis, again, when Argentina got killed, everything else went to 250, so it went down about 80%. Roughly 10 years later, it was trading nearly 10 times higher. And really, I think I don't know if it's going to go this low again, even despite everything's happened. It might go back to 2 or 3, but I think you're never going to get the exact low in these things. But you can see this stock is down over 80% from its high, pays a very nice dividend, and might be worth a company to, edge into. So another maximum pessimism trade at the moment I'm looking at is Turkey. So this is TKC, the telecom. The reason I like telecom companies is because they're leveraged. They have a lot of debt, but they're also monopolies. People are always going to use their cell phones, even during crises, right? If anything, people might use their cell phones more because they're unemployed and they got nothing to do, right? So you can see TKC went from over $20 down to $1, and then over the next, again, 7-8 years, rebounded to about $15 a share. And then, you can see again, has now gone back to $3 or $4 a share. Pays a really nice dividend. So this is something, and actually in my new service, I've actually done my first tranche at about $3.40, $3.50 a share. I'm actually hoping it goes under 2. So I think we'll get another excellent thing. The Turkish, again, you can't really look at the Turkish market because the Turkish market is going up because the currency is crashing. But in US dollar terms, you can see since the pre-financial crisis high, this is down about 80%. And this is the actual Turkish market. If you're someone who just doesn't want to buy one company, and you can see again, when it collapsed in 2008, there was a very nice about 4x return on your money in the next couple of years. And again, we're down about 2/3. So if in American dollar terms, the TUR could go back to say 15, I would be all over that. So, and this is how maximum investing works. Now, another sector I was bullish on was, even though I'm not known as a tech guy, was the 3D printing market. I think this is a huge market in the future. And you can see, now this chart doesn't do it justice because on a log scale. Now we go to a linear scale, you can see the parabolic blow off. It's one of the first bubbles of this bull market from 2009 to 2014. And you can see that, it went to the single digits in 2016. That's really where I would have looked at it, below 10. And there was a little spike here to, $40, $50 a share. So if you had been buying it cheap in 01 when tech stocks got up, you probably would have made 3-4 times on your money, and then could have got out because you could tell, you also have to use some common sense. You could tell it was just getting taken up with a bubble in the entire market, and the fundamentals still weren't there. But luckily, it's come back down for us. And if we get back into the single digits, back to that $5 to $10 a share, this is, I think, a long-term, like I said, growth industry. And I think that you're going to be rewarded 5 years out, that sort of thing. And this has already had its bust, where the rest of the market is now busting right now. Another example of it was, and we're going to get into gold stocks. I think gold stocks are getting there right now. Actually, we'll do that in a second. Of a market was, let's go look at oil stocks. This was a stock I recommended. We got out of it a little early, Athabasca Oil and Gas. Now the log scale will show this better. We can see it IPO'd around $17, $18 a share at the top in oil roughly in 2010, 2011, fell all the way to 10 cents a share. Now, when it was 10 cents, when I was looking at it, I just figured it was not going to go under. So I recommended buying this. I sold out too early. I sold out, I think, between 60, 70 cents. And it's like now $2.50 a share. I actually had a subscriber who wrote me saying, thanks, Dave. I'm up 20 times in Athabasca Oil. And I'm like, that's great, man. I'm so happy you held, you know? So this is, again, oil went negative. The sentiment was terrible. Maximum pessimism. You take oil on the cash low at that point, oil was down, 114, or sorry, 140, if you want to take the all-time high, but let's even take the most recent high in 2018, just about $75, $80 a barrel. Intraday print under 10, closing low about 15, down, depending on where you looked at oil's high, down 80 to 90%. So oil itself did fantastic, and Athabasca and many oil companies, especially the leverage plays like that, did even better. So you want to buy these maximum pessimism, kind of holdings. And like, if we all talk about, everyone wants to chase these tech stocks and chase Apple and do all these things. And, but Apple starting like 5-6 years ago was not cheap. And Apple's gone up, done very well, gone up about 5-6 times. But it's like, why not just buy Athabasca when it was 10 cents? You could tell it wasn't going to go under. You would, your return was 4x Apple, right? Now Apple, and worked for Apple too, by the way. Apple came out in the 80s, peaked. You can see this, there's a million splits in there, over 60 cents a share. You can see in 98 was like 10 cents a share, down 80%. If you bought that, you're up 1,500 times in Apple, right? Even if you bought in the 03, 04 low, 30 cents a share, you're up, 400 times. So it's like, even Apple had a tough time, had a maximum pessimism trade, and then did great. And okay, Amazon did the same thing. Amazon traded down to $5-6 a share, the dot-com bottom, and look what it's done since then. So granted, Amazon has done great ever since. So you were fine buying at any time, but again, the best time to buy Amazon was during that pessimism type low. So now let's look at gold stocks. So gold stocks, I don't like to chase at all because it's very cyclical. They're huge booms and busts, etc. But this is the HUI index, and you can see it went down about 80% in the late 90s into 2000, 2001. And then in the next 15 years, I went up 15 times the value. And there were two big busts. In 08, 09, I went down about 70%, and then went up 4x, and then I went down 80%, even more, and then went up over 3x. So we can see we're down here. We're still cheap level, especially when you consider where gold is. But I think where the real value in the gold stocks here is the juniors. So the CDNX, which is mostly made up of juniors, it started here because it went from being the the Vancouver Stock Exchange to the CDNX. And you can see this spike was because of the dot-com bubble. A lot of tech companies are in it. But in about 2000, 2001, it was probably down 3/4, had a huge run here. And again, the low here in 2009, if you had bought when it lost, 70%, 70, 80%, there was a great rebound rally. And then here as well. But if you let's go look at this over the last, 10, 15 years, you can see 500 or 750 is kind of the level. And 500 is extreme level, kind of like under 4. When it 70-50 here, 750, I went under 750 to 500 here, and then went to, under 500 here or to 500 here. Every time there was a good move lower. And what we can see is in the junior market, we're back down to 712. So we're under the 750 and we're at 712. So you might want to pick up the juniors. And if there is another bust lower in the market, which I think there will be sometime this summer or this fall, we can buy the juniors here. Okay. So, and I think your returns will be great, you know, and we can show you many junior stocks. Some of them have been taken over. A lot of them have been taken over, but I had many junior stocks that I bought, like this is African gold. You know, if you had bought African gold in 2020, you know, under 10, or so there's Aftermath silver. And I'll show you Aftermath silver was my perfect example. I started buying this at 8 cents in, 2019, and it went to $1.20. And you can see during the 2020 bust went from 6, you could go back in at 8 and went up 15 times in value. So now this stock is down about 80%. It's got a lot more going on now than it did in 2020. So I don't know if it's going to go back to 10 cents, but probably again at 26 cents, this represents a pretty good thing here. So another one, and this is one of my new recommendations. So now I am giving, or one of my new watch list addings. This is Eurosun Mining. They have a near production mine in Romania. And you can see this thing in 2018 was over $1 a share. And now, and in 2020, after it fell to about 12, 13 cents in the crash, went to 60 cents a share. I recently just bought some in a family account at about 17, 18 cents a share. You can see that from the 2020 high of 60, it's down about 70%. Maybe it'll go down to 80%. But I think this is great value. And with the juniors, it's a little different than just, buy the 9. You want something that is maybe near production, has had a lot of things go on, but for whatever reason, the price isn't reacting. That's the kind of thing, excuse me, you want. So then another interesting deal to me, this is CAT Strategic Metals. They're doing a private placement at 3 cents. I'm about to contact money. I know some of you did the private placement. I think it was like 8 cents. I did it there as well. Stocking sees about 2.5. But at 3 cents with a 5 cent warrant, I think this is excellent opportunity. Reminds me of Avion Silver did a 6 cent placement, I think with a 9 cent warrant back in 2009. The stock went to $2. So at these levels, when you're talking buying something at a $4 million Canadian market cap, is again off the 95 cent level, you get the warrant thrown in. I think you're really, really good to get into the stock at these levels. Now there's a weird intraday print there in 2019. That's why you get that. But I think this is something I would really look at getting in on the private placement. I know many of you do the private placement. So I'll add this to the watch list as well. Then the other one I'm going to add finally is African gold, same group as Eurosun, same thing. I just bought some of this around 9.5, 10 cents in a family account. We go look at this a little further back, 5 years. Again, it was 50 cents back in 2019. You're down 80%. So I think these kind of juniors, who knows, maybe in a bust, this could go to 5 cents. But like now you start edging in. Now the CDNX is in the buy territory. These juniors are completely beat up. These are the levels you really, really want to get in. And because juniors are more of a trade than a long-term hold, I think that's really what you have to look at. So I hope I've helped taught you a bunch of things here. And I've shown you how this kind of maximum pessimism, I've showed you 3D printing stocks. I showed you even stocks like Apple and Amazon. I've shown you Greece. I've shown you Iceland. I've shown you now, I think Sri Lanka would be good. I think this is the time to kind of buy here. I think another excellent buy. Now I'm not as big on this as I was, but this is an Eastern European fund. And, obviously with Russia, now Russian holdings are basically out of this now, and they've kind of replaced them with some holdings in Austria, Switzerland, and Germany, which I'm not a huge fan of. I'd rather have the have sole exposure to Eastern Europe, but it does own Polish, Hungarian, obviously Eastern Europe is the epicenter of the crisis here. And this, you can see, went down about 80%, mostly because of the Russian holdings. I think Russia was 70 to 80% of it. So I don't know if it will rebound as quickly, but you can see it's up 6% today. So I think that this is another excellent maximum pessimism play. The kind of more politically incorrect way way people put it is you buy when there's blood in the streets, and that's obviously what's happening, unfortunately, in Ukraine and in Sri Lanka. So, and I'll give you another example. I love emerging markets when they get killed. So we can see this is an 18-year chart of the Bombay Stock Exchange. And you can see, it fell over 70% in 2008, went up like crazy, again, got killed during COVID. Returns have been exceptional in this after every bust. And actually, even with the currency devaluation, longer term in India has always outperformed the US market in these rebounds, especially the early parts of the rebounds when emerging markets, excuse me, tend to lead the way. So this is, you can see the Bombay Exchange, again, that got killed, went from 6,000 to near 2,000, 2000, 2001, went up nearly tenfold, and then went down again to 8,000. And then again, just from, we're just talking the 2 years after the bottom in 08, more than doubled in value. So, the S&P did not more than double in value in 09, 010. So that's another thing. If we do get a bust here, I'm not saying to buy it here, obviously, you can see we're at a pretty heady level, but if we get another, whatever, 30, 50, 70% bust, and if that 30, 50% ends up being 70% in US dollar terms, you want to be all over these Indian stocks. And one I really like, two I really like that I've talked about in the past, I'll show you here. This is the India Fund, which pays a gigantic dividend too, by the way. So maybe it doesn't have the huge capital gains, but you can still see after 08, 09, it went from 4 to nearly 12. But you're getting 10% a year dividends in this as well. That's a great conservative way to play it. And I always love Tata Motors. They own Land Rover and Jaguar. You can see the two huge dips in Tata Motors in the last 15 years. When it went, I recommended this right almost the day of the bottom in 09. Don't expect that all the time. I think at 350 a share. You can see it was 35 a share by the end of 2010. And then you can see it eventually went to 50 and then bottom below 5. So if Tata Motors can get, again, kind of, I think we're pretty early on in this decline right now. But if Tata Motors get back in this single digit range, especially below 5, you will want to be buying. So anyhow, I hope I taught you about maximum pessimism, the kind of returns you can get. And this, I said, you got to be patient. If you just waited twice, and then you don't have to work as hard too. You don't have to look at trades all the time, do this all the time. You waited 15 years. You waited twice for Tata Motors to fall, 90%. Guess what? You had 2-year returns in each case of 1,000% and 500%, 600%. And then you could just sold and go to the beach, So, but you have to be patient. And I know in this day and age, especially with these idiots who trade crypto and this and that, they want, day to day this, trading 5-minute charts. But with this kind of maximum pessimism thing, you just wait patiently. You see a market kind of like Sri Lanka now, or like Eastern Europe now, and then you jump on top of it. And even in this great bubble since 2009, since, the stocks made the most overvalue they've ever been. Let's look at, we had Europe in 2012, okay? We had oil stocks in 2015 to 2018. Russia in 2014. Obviously, you can't trade Russia now. Eastern Europe now, right now. Sri Lanka right now. Greece, like I said, European stocks, Italian stocks. There were all kinds of stocks that were cheap in 2012. And then gold stocks in 2015, 2016. If we go look at the HUI, you can see that, again, the gold stock index was down over 80%. So even with all these bubbles, Western Europe 2014, Russia and other commodity countries 2014, 2015, gold stocks 2015, 2016, oil stocks, anywhere from basically 2015 to 2020. There are times that were better. Obviously, like I said, Eastern Europe, Sri Lanka now. You've had about every 2 to 3 years a great maximum pessimism buying opportunity, right? So even in bull markets, there's that saying, there's a bull market somewhere all the time. There's a bear market somewhere all the time too. In the 90s, during that bubble, one of the best buying opportunities, and John Templeton did this, was buying the emerging markets. It was 97, 98. Again, Russia. Get back to Russia. Russia fell 99% adjusted for like the US dollar, and it went up like 100-fold, 50 to 100-fold, you know? So even during that big boom, you know, South Korea, Taiwan, they were all great buys in 97, 98. So even during these big bubbles, if you just wait patiently, don't have to get caught up in the frenzy, you can buy a lot of these assets, you know, very, very cheap and do well. So I'm going to stop. This is I know this was quite a long video, but I think this is a very important subject. And this is kind of what my newsletter will deal with. We'll talk about these things in the Patreon account. I need to have a drink because my mouth is, all I've been doing is drinking a coffee. And obviously that's dehydrating. So I need to get some water in me, you know, to get some, or some, you know, coconut water, get some electrolytes in me, you know, to get some hydration in me. Anyhow, I hope this taught you a little bit. And I really believe this is a great way to invest.